the elephant previously named privateequity.biz is a secondary market platform for trading of shares of late-stage private companies. And I'll take that long sentence and dissect it. If you're a shareholder in a late-stage company, pre-IPO, unicorn, if just to give examples, and there are still private companies. We're talking about Uber, Airbnb, just to name a few. These companies are still private. They've created enormous value. Could be billions and tens of billions of dollars, and they're still private. They're not going public. And their shareholders, on one hand, are enjoying from a great increase in the value of their shares, but on the other hand, they have absolutely no liquidity for them. So these are the type of assets that we want to give access to sellers and to investors. And if we're looking back 15, 20 years ago, this asset class was not available. It did not exist. The reasoning behind it is because there was no need for it. Secondary trading is an interim solution for once value is created until it's actually reaching liquidity, which is going public. 15 years ago, it just was not. It didn't happen because companies went either public, after 3 to 5 years, or they failed and closed down. So there was no need because an investor came in, sat on an investor, and he understood that he's coming in for a period of 3 to 5 years. After the dot-com bubble bursted, companies are no longer going public at $200, $300 million valuations after 3 to 5 years. There's more available capital in the private market, so they don't have the need to go public in order to raise that substantial amount of money. On the other hand, regulation has tightened up on them, so they're less incentivized to take all these obligations on themselves. So they said, hey, we'll just stay private, create more and more value, and we'll go out public if and when it suits us on our terms. And what happened is that now you have more and more value created. You have 250 unicorns worth billions and tens of billions of dollars, and they're just not going public. They will eventually do it, but it will take them 12 years, 15 years, in some cases, even more than that. What happens is that the people that are holding their shares are locked. You have all these enormous value which is being created more and more, but it's staying locked up for a longer period of time. The secondary market really is the solution, the interim solution for that period. And we're talking about we've been talking about crypto industry this morning, which is the biggest creation of value ever in mankind. But if you put things in perspective, take the secondary market. The secondary market has grown over this past decade by over 800%. Because as we explained, more and more value is created and is staying locked for a longer time. The elephant is a platform that wants to provide these shareholders, and our special angle is the small shareholders, with access to liquidity, with access to investors that want to invest in this asset class, the pre-IPO asset class. Meaning you come in at the pre-IPO market, later stage company, and you want to ride it out till the IPO a couple of years later. So, that's, and the secondary market has grown from $4 billion 12 years ago to almost $60 billion this past year. Again, the reasoning is understood. The need is just growing, and the secondary market is growing on a regular basis. Now, what we've understood is that we want to provide access to these shares, so understand where the need is coming from for all the shareholders. We also want to open up this investment class to more and more investors, because customarily you have secondary funds that are interested in investing in this class of investments, but they're looking at big blocks. They're looking at $5–10 million. They have full due diligence and cooperation from the company. But if you're a small shareholder holding $1 million, these companies are not going to cooperate with you and provide information. So, which is another barrier for you to selling your shares. what we want to do is we want to provide access to these shares in small stakes, you know, starting at $20,000, $50,000, or $100,000. Now your risk profile and, you know, investing in these high-profile companies has changed because you want to invest in them. And how do we do that? We want to open up this investment class to more and more accredited investors, only accredited investors, because we have to abide by security laws, and we're obviously not trying to play around with these shares. But how many accredited investors want to invest in these shares, and they can't do it because, like we said, there's, you know, big blocks going between, you know, a fund that was holding it, created value, and now they're selling it to another secondary fund. You don't have access at, you know, $100,000 in these companies. That's what we at the Elephant want to provide. We're giving access to sell your shares to small shareholders, and we have our innovative ways of doing it. And we're also giving access to investors to invest in these shares by basically setting up a special purpose vehicle for each one of these investment classes.
So far you've described a secondary market platform, and the Elephant is an existing platform, been around for almost 4 years and being operational platform. But now shifting into blockchain. So how is the merge between the secondary market, the growing sector of secondary market with blockchain or crypto is being made?
Right. So as I said, what we want to do is our main thing is to provide people access to options. So you as a selling shareholder can elect how much of your shares to sell, at what price, and, you know, you as an investor can decide in which companies you want to invest in and how much you want to invest. The problem was that still, you know, the secondary market is suffering from a problem of liquidity. If it was a big challenge to provide liquidity to the selling shareholders, now my investors that come in and are investing in these special purpose vehicles that are holding shares of these unicorn companies, now they don't have liquidity. Now they need to, you know, sit out until the IPO. Granted, that was their investment strategy, but that can take a couple of years. It can take 2 to 4 years until the company goes public. Now, tomorrow, the company comes out with great news. They've raised capital at a triple valuation. How do you benefit from that appreciation in the value of your assets? So, as I said, the secondary market is growing, but we've been following blockchain technology evolving and growing by itself, and we were waiting for it to reach the point where we can actually take advantage of this great technology and the access to liquidity that it provides. And, you know, a couple of years ago came up this new blockchain at the time called Ethereum, which allows you to now basically take contracts and put them into a digital way into smart contracts. So now look at our platform. Our platform is very paperwork oriented. We have these agreements, transfer agreements, and partnerships agreements, and transfer agreements. And if we can take blockchain technology and basically upload everything into smart contracts, that by itself allows us to you know, lower costs, being more efficient and whatever. But there's another added value into implementing blockchain technology, and that is tokenization. We're not a crypto story, we're a tokenization story. Because if now I can take these equity rights in these shares and basically represent them through tokens, through security tokens, and as security token exchanges come up and provide liquidation for these security tokens, we can take something that, you know, is two growing industries, combine them and create something that provides a much more appealing solution to the investors. It gives access to more and more investors. It becomes global, it becomes 24/7, but we're doing it in what we call conservative crypto way. Because at the end of the day, you're not depending on these tokens to perform in order for you to create value. Which means if the token, you know, goes up in value because, like I said, the company came out with the good news or whatever it is, go ahead and you know, sell your tokens through the liquidity advantages that we're giving. On the other hand, as opposed to, let's say, utility tokens where you're supposed to depend on, I'm talking about the investors that are not actually investing to actually use the tokens for whatever utility they're supposed to represent. But as an investment class, if the token doesn't perform, you lost your investment. In this case, these tokens are representing real-world assets that are underlying them. So you're not depending on them. It's just, you know, taking the secondary platform, enhancing it, and providing another liquidity aspect, another layer of liquidity, but in a protective way.
So in order to make it, in order to simplify it for people, let's take a use case. I'm a former employee at WeWork. I've been a C-level executive for a few years, or I'm a seed investor at WeWork. Give me the flow, the process. How would it work? Okay,
so since you're saying you're not a VC that's been sitting on, you know, block of $10 million, $50 million worth of WeWork shares, because in that case you don't really need me. You can go and find yourself a broker that will bring you a secondary fund to bind your shares. If you're that former employee, your shares are worth $1 million, $10 million, whatever it is. Again, company's not gonna cooperate with you in order to help you sell your shares in terms of providing information that will allow you to provide it to your prospective buyer. You're on your own. Now you need somebody to help you. Even the secondary platforms that provide liquidity solutions that are out there, they don't deal with small stakes. They don't, you know, if you take NASDAQ Private Market or Shares Post, they'll deal with the big blocks and deal with the company directly and you know, and provide liquidity. But you as a shareholder, you don't really have a say in the matter. If, when, how, what is the price, what kind of lockup they'll implement on you. We also, we see ourselves also as a social platform. We will allow you to load up your shares on our platform. Obviously, we're going through a vetting process where we only take on companies that are late stage, okay, that have sophisticated investors that have raised over $50 million. So you as a buyer understand that somebody already did the diligence. It's not up on you. And what we do is we will allow you to upload your shares. We check the shares, we check the companies, we check your shareholdings, and you know, we allow you to list them on our platform. Now, we're not interested in doing transactions of $250,000. That's not a business. But we do aggregate, you know, we'll take from 10 different employees, 500 from this guy, 250,000 from this guy, whatever. We'll create a block, and that is already by itself something that is worthwhile dealing with. From the other angle of this, and it's a triangle, we have the investors. An investor wants to invest in these companies. Once I set up this SPV that will buy the entire block of shares, I'm creating one transaction. Once I set up this SPV, this special purpose vehicle or partnership, I can slice it up, and you as an investor can decide how much you want to invest. And again, that adjusts your investment profile. Now, if you want to invest $50,000 in what was it? WeWork, right?
Uber.
Right? So it's a company that's in the news all the time, you know. WeWork wanted to raise debt, so they disclosed some of their information. I'm also providing you with an independent third-party analysis report from, you know, a company that is what they do. As the secondary market evolves, so are many of the services that come with it. One of it is analysis companies that come out, and based on BI and AI.
Investor, I'm not getting the shares of the company?
You're not getting the shares. You're investing in a special purpose vehicle that holds that block of shares. So what I'm creating now is I'm creating one transaction. I collected from all these shareholders. I collected all these investors into the special purpose vehicle. And now when I want to implement a transaction, and since this is a private company, I have to go through a first refusal with a company, sometimes board approval. I'm also, and this is the third angle of the triangle, the company, because at the end of the day, I want to serve their purposes. I don't want to defy them. I don't want to get against them. They understand that after, you know, being private for 8 years, they have shareholders that need liquidity. They understand that for them to enjoy for more freedom to wait with their IPOs, with their exits, another 5 years, they need to provide some kind of solution to their shareholders along the way. I'm looking to help them. If I will come to them with every transaction of, you know, $500,000, I'm driving them crazy. So, you know, first time they'll play along. After a while, they say, listen, I got $1 billion company to run here. Stop bothering me. By creating that solution and basically aggregating all these small transactions into one transaction, I'm able to simplify it for the company. I'm able to provide liquidity to the small shareholders, and I'm able to provide access to these shares excuse me, to these shares in small stakes and open it up for a bigger crowd. The advantage of using this model is that now I can, since I have the shares sitting in an SPV, which is under my management as the GP, I can tokenize these participation units to be reflected as security tokens.
So for the seller, you create a new set of buyers that would like to buy the shares. For the buyers, you create a liquid solution for these unliquid shares. And for the company, you reduce the amount of shareholders on their cap table, so all the three-party gain benefit from the process.
Correct, correct. You know, we're taking our solution to the secondary market, which is innovative by itself, and then we explain what are the benefits of doing it. And all we're doing is just providing, we're enhancing the solution that we're providing. And by providing this liquidity, and another layer of liquidity through the tokens, I'm saying, aside from the operational side of things, which helps me, we are providing another layer of liquidity, but at the same time, you're not dependent on it in order to make a profit. Because if the token, again, goes up in value, great, enjoy it. If it doesn't perform or whatever, you're just back to square one where you were with, you know, the non-tokenized platform where you're sitting on equity rights in these shares in pre-IPO companies. And once you have an exit or a success there, you're still enjoying from your investment.
We don't have a lot of time, and we want to still keep another one or two questions from the audience, but let's talk about the stage that we are at and the STO, the security token offering that the Elephant is currently doing.
Right. So as I explained, the Elephant is you know, is an operational platform. It's been around for the last couple of years, and we don't just have an idea that this is what we want to do. We have a platform. We have shares that are listed on it worth over $70 million from 20-some companies. You know, you can look up on our site and see the names. We have 2,000 listed investors, and basically, we want to grow this platform not to have $70 million. We want to have hundreds of millions of dollars. We want to have not, 150 employees selling shares. We want to have a lot more. In order to do that, we need to, reach out to them and get to them, and that takes money. We need to invest in, in marketing and a little bit more marketing, and technology, and whatever comes. But we have to reach out and create exposure for our platform. So what we decided is, as part of the tokenization process of the platform, we're also going to come out with our own ST, our own security token offering, and offer a platform token, or PEC, or private equity coin. And as Jeff earlier this morning mentioned, the idea is that now you're creating your own security token, and you're providing your investors with an opportunity to enjoy from helping you building your business. And that's what we're doing. We want to invite people to come and invest and buy our token, and what we're offering them is revenue sharing from the platform. The platform has its own value creation, which is, we understood what is the value proposition of these dedicated tokens. They're representing the underlying shares. The platform by itself has a lot more value drivers than just the underlying shares. So what we're offering is, come invest in our security token of the platform, help us grow it and benefit from the revenues that are going to be generated by the platform. At the same time, since we have all these special investment opportunities that are available on our platform, those are going to be reserved initially only for our community.